Welcome to your channel, Dr. Gazavi. Economics and financial issues are very important. Let's go.
Does oil predict gold? A non-parametric causality in quantiles approach. This paper examines the predictive power of oil price for gold price using the novel non-parametric causality in quantiles testing approach. The study uses weekly data over the April 1983 to August 2016 period for both the spot and 1-month to 12-month futures markets. The new approach, the causality in quantile, allows one to test for causality in mean and causality in variance when there may be no causality in the first moment but higher-order interdependencies may exist. The tests are preferred over the linear Granger causality test, which might be subject to misleading results due to misspecification. Contrary to no predictability results obtained under a misspecified linear structure, the non-parametric causality in quantiles test shows that oil price has a weak predictive power for the gold price. Moreover, the causality and variance tests obtain strong support for the predictive capacity of oil for gold market volatility. The results underline the importance of accounting for nonlinearity in the analysis of causality from oil to gold. On account of oil's frequent traceability, voluminous trades, high liquidity, and synchronization of its movement, gold has held its righteous positions not only nationally but in international economies as well. Oil is the commodity with the highest volume of trade and with higher price volatility, and gold, on the other hand, is the most traded precious metal with the lowest price volatility. A comprehensive analysis of oil and gold prices suggests that prices of both are strongly related. Oil and gold hold a positive price correlation of 80% in the last 50 years. 1 There are a large number of studies suggesting that oil price changes give rise to price variations in gold. To illustrate, according to Sari et al. 2010, gold price changes are related to oil price changes, and oil price changes explain 1.7% of the price change in gold. Hence, an empirical study is of enormous importance in examining this relationship, and this study aims to examine the causality in quantiles running from oil to gold. There are several channels accounting for the relationship between oil and gold prices. Many oil exporting countries, for instance, perform oil transactions in return for gold. Due to its nature of safe investment, oil revenues are invested in gold. Besides, the costs of gold mining are very much related to energy and oil issues. This being the case, a rise in energy and oil prices inevitably has an impact on the costs of gold mining. Another channel effective in explaining the relationship between oil and gold prices is inflation. As a support to explain this connection, Narayan et al. 2010 argue that the relation between oil and gold prices can be best explained through inflation. Other things being equal, a rise in oil prices at the international scale will affect the prices in global terms and will have a negative effect on the oil importing countries, yielding a negative relationship between oil and inflation. Nowadays, gold is regarded as an instrument investors buy to balance their portfolios during times of high inflation. Ghosh, 2011. Since gold is a safe means of investment, safe haven, the price of gold goes up in high inflation periods. Hence, as oil prices rise, so does inflation and the price of gold. The literature on the oil and gold price relationship and their interaction with a specific emphasis on macroeconomic and financial issues are scant. Each economic crisis led to some studies into the issue, especially gold seen as a safe haven. One of the leading studies is that of Melvin and Sultan, 1990, and Kim and Dilts, 2011, in which they found a high correlation between oil and gold in terms of export channels. Nevertheless, the literature hosts other studies with no evidence of the relationship between the rises in prices of oil and gold, e.g., Soitas et al., 2009, Liao and Chen, 2008, Sari et al., 2007, Hamada and Yuan, 2008, Narayan et al., 2010, Simikova, 2011, Lun Chong, 2011 and Li et al. 2012. Sari et al. 2007, examined the dynamic links among commodities such as oil, gold, silver, and copper and financial variables, exchange rate, and interest rate. Their results showed that gold and exchange rate have predictive power for oil, but oil does not have significant explanatory power for these commodities. Soitas et al. 2009, studied the dynamic relationships among the oil, commodities, gold and silver, and financial variables, dollar exchange rate and bond rate, in Turkey. They examined both the short and long-run dynamic interactions and concluded that oil prices do not have significant explanatory power for gold. Thus, the empirical evidence on the relationship between the oil and gold markets can be best described as mixed, if not confusing. The studies on the oil-gold relationship center more on whether oil has predictive power for gold, and given the mixed evidence, further studies are needed. The mixed evidence on the relationship between oil and gold gets even more complicated due to the use of different sample periods, methods, and countries under consideration. What is more important is that no comprehensive and insightful study exists to date to examine the relationship between oil and gold prices. A study that takes into account non-linearities, structural breaks, outliers, and effects of extreme market conditions in the analysis of the oil and gold market relationship will resolve some of the ambiguities relating to the empirical studies. Against this backdrop, the objective of the current study is to use the recently proposed non-parametric causality in quantiles test by Balsilar et al. 2016a, Balsilar et al. 2016b to analyze the predictability of mean and variance of gold price by oil price. The weekly data for the spot and 1 to 12-month futures prices of oil and gold market have been employed. The sample period ends at the 10th of August 16 and the beginning of the sample varies from the 6th of April 83 to the 8th of January 86 due to the varying operation startup times in the futures markets. Our first contribution to the literature on oil and gold price is that, rather than focusing on specific episodes of market periods, we use a non-parametric quantile testing approach which is rich enough to consider all market conditions jointly: low volatility, high volatility, crises, crashes, or bubbles. Thus, we can examine the predictive content of the oil market for the gold market under different market conditions. This will allow us to see under what conditions oil does predict the gold or does not. Our second contribution to the literature is the consideration of the both spot and futures markets. To our knowledge, Narayan et al. 2010 is the only study considering futures markets. However, our study considers dynamic non-parametric quantile Granger causality and, therefore, significantly differs from Narayan et al. 2010, which only considers contemporaneous relationship via static regression. Our third contribution to the literature is the examination of causality not only in mean but also causality in variance, volatility. Previous literature only studied the predictive power of the oil for gold in mean. Oil market may have predictive power for the second moment, variance, even if it does not have predictive power for the first moment, mean. The predictive power of oil market for gold market volatility can even be more important for investors and portfolio manager in developing hedging strategies. Our last contribution to the literature on oil and gold price causal nexus is that we use a novel non-parametric causality in quantiles test recently proposed by Balsilar et al. 2016a, Balsilar et al. 2016b to study whether oil price causes gold price returns and volatility. Their test integrates the test for nonlinear causality of KTH order developed by Nishiyama et al. 2011, with the quantile causality test advanced by Jung et al. 2012, and, hence, can be considered to be a generalization of the former. The causality in quantiles approach mainly has three novel aspects. First, this approach identifies the dependence structure of the time series under consideration using a non-parametric estimation, and therefore misspecification errors are at minimum level or none. Next, it is viable to test both causality in mean and causality in variance. This being the case, it allows for higher-order dependency investigation, considered an essential point since there might be no causality in the conditional mean for some periods. But higher-order dependency might exists in the same periods. Finally, to date, this paper is the first one to examine the predictability and volatility of gold returns with the non-parametric causality in quantiles method, to the best knowledge of the authors. Our results show that oil prices have a weak predictive power for gold markets, as suggested by the results of the non-parametric causality tests. Still, we obtain strong evidence for causality and variance tests as we strongly reject the null hypothesis that oil prices does not Granger cause gold price volatility for spot and the futures markets at all maturities. There are some studies, e.g., Zhang and Wei, 2010, holding that oil and gold prices have high correlation, which is attributed to the phenomenon that high oil prices could have negative effect for economies and which in turn has an adverse effect that lowers the share prices. Killian, 2009. Also, according to Melvin and Sultan, 1990, export revenue channel may be used to explain the relationship between oil and gold prices. In an attempt to distribute the risks involved and to sustain the value of commodities, and in order to possess more gold in their portfolio, major oil exporting countries invest the revenues obtained from oil in gold, paving the way for a rise in price of gold by increasing the demand. Finally, as stated by Narayan et al. 2010, Hooker, 2002, Hunt, 2006, and Beckman and Zudai, 2013, inflation channel fits well in explaining the relation between oil and gold markets. On the other hand, there are studies, e.g., La and Chong, 2012, Bompinas and Panagiotidis, 2015, claiming that oil and gold prices go hand in hand due to the correlation stemming from the volatility in US dollars and in international politics. Conclusion. The extant literature so far has examined the oil market with respect to its predictive power for gold markets. This paper adds to this literature by means of examining the predictability of gold markets for the mean and volatility by the oil market. To serve this purpose, using weekly data, standard linear Granger causality test is implemented, but no evidence has been found about causality running from oil market to gold market. Following the nonlinearity tests, we find oil returns' relationship with gold returns have nonlinear characteristics, which suggests that the linear causality tests suffer from misspecification, thus yielding unreliable results. In order to overcome this problem, we employ a non-parametric causality in quantiles test, incorporating the test for nonlinear causality of kth order developed by Nishiyama et al. 2011, with the causality in quantiles test developed by Zhang et al. 2012. This approach, the causality in quantiles, enables us to examine causality in mean as well as the causality in variance. In this way, even when there might be no causality in mean, we can still examine the causality in variance, volatility. The non-parametric causality tests in mean indicate that oil prices have a weak predictive content for gold market. Yet, the null hypothesis that oil prices does not Granger cause gold price volatility for spot and the futures markets at all maturities is strongly rejected for both spot and futures markets. The results on the nexus between oil market and gold market, on the whole, underline the significance of detecting and modeling nonlinearity when examining predictability via causal relationships. The hump-shaped pattern in causality in quantiles tests we have found for causality running from oil markets to gold markets, both for causality in mean and variance, highlights the strong causal effects at the center of the conditional distribution of gold price fluctuations. In other words, the strongest effects of oil returns on gold returns and gold volatility may occur on average, especially at higher data frequencies, weekly data, in times of normal rather than in times of exceptional movements of the gold price. However, this finding does not rule out that singular events like the outbreak of a financial crisis or geopolitical turbulences that trigger significant movements of the gold price. But it rather highlights that investors and policymakers should study the entire conditional distribution of gold price movements when looking for causal effects of oil that operate, for example, in normal times and in times of gold market turmoil. Similarly, an asymmetric hump-shaped pattern of causality highlights that the strength of causality effects differs across the upper and lower parts of the conditional distribution of gold price movements. As we pointed out, events such as important financial crisis or geopolitical events that trigger significant gold price fluctuations are not ruled out by the strong causality evidence on the center of the gold returns distribution. But it rather highlights that investors and policymakers when looking for causal effects from oil to gold markets should consider the entire conditional distribution of gold price movements, not only the center of the distribution which corresponds to low return periods. The asymmetric hump-shaped pattern of causality running from oil to gold markets found in our study highlights that the strength of causality effects differs across the upper and lower parts of the conditional distribution of gold price movements. These results imply that investors should be aware that predictive power of oil prices for the gold prices observed in normal times weakens during extreme market conditions, low and high gold price periods. In terms of hedging strategies for portfolio managers, our results show that gold is a safe haven against extreme oil price movements, but it not an effective hedge instrument against oil price during the normal market periods. Investors should also know that oil price would only indicate direction of gold price movements during normal market periods. Oil prices do fail to predict the extreme gold price movements, particularly the extreme price increases.
Thank you for watching, and please subscribe to our channel. Economic and financial issues are very important. See you in the next video.